We should include this in the financial statement cycle. First, sale and collection cycle. Second, acquisition and payment cycle. Third, payroll and personnel cycle. Fourth, inventory and warehousing cycle. Lastly, capital acquisition and repayment cycle. For sales and collection cycle, process begins when the customer purchase goods and services, ends when the company receives complete payment. To ensure company is not materially its revenue or account receivable. For acquisition and payment cycle, first to evaluate whether the account affected by the purchase of goods and services. Second, to ensure that goods and services are for authorized company purpose. Third, to avoid the purchase of excessive or unnecessary items. For payroll and personnel cycle, to evaluate the account balance affected by the cycle are fairly stated. For inventory and warehousing cycle, what should be included? First, purchase history report. Second, inventory price file. Third, inventory context. Fourth, final inventory list. Lastly, adjusting journal entry report. For capital acquisition and repayment cycle, it is related to financing the business. There are two reasons for treating capital acquisition and repayment separately. First, transaction related to financing company. Second, most capital acquisition and repayment cycle account involve three transactions. What the relationship among the transaction cycle? This is the relationship among the transaction cycle. There are several audit objectives must be made before auditor conclude that transactions are properly recorded. They are somewhat different but closely related. For example, transaction-related audit objective is there are specific sales transaction and specific sales return. Meanwhile, balance-related audit objective, there are several specific accounts receivable.
How about the next steps to develop audit objective, which is to know management assertions about account?
There are 7 categories of assertions. First, existence. Second, occurrence. Third, right and obligations. Fourth, completeness. Fifth, valuation and allocation. 6, measurement. And 7, presentation and disclosure.
Existence is the asset and liability exists at a given date. For occurrence is a transaction or event has taken place. For completeness is the account and transaction that should be incurred and included when the financial statements are complete. For the rights and obligation is the asset or rights of the entity and liabilities are its obligation.
Next, valuations, where the assets and liability are recorded appropriate carrying date. Measurement, a transaction is recorded at the proper amount and revenue or expense is allocated to the proper accounting period. Lastly, presentation as disclosure, which is amounts shown in the financial statements are properly presented and disclosed.